house prices have been increasing rapidly recently, and certainly for some markets it looks like we're entering a house price bubble. So in this video I'll look at the drivers behind that, but also which countries are looking the most expensive. Then I'll look at the UK market and the US market in more detail, and I'll end with a house price forecast model that should give us some insight into what could happen next. And remember, if you do want to not miss any of our future videos, then just click on subscribe. Let's start off by looking at the factors which drive house prices up globally. Central banks set policy rates, and these are the policy rates for 5 of the largest central banks across the world. And you can see the trend has very clearly been downwards, and the effect of the recent pandemic has been to push down those rates almost to zero across the world. Now, usually mortgage rates are that base rate from the central bank plus a little bit of spread. And that means that it's become very cheap to get mortgages. And in turn, that means people can borrow more, and that tends to push up house prices. So low interest rates are definitely a positive factor for house prices globally. And if we look at the price of fixing a 30-year mortgage in the United States, currently it's almost at historic lows. It's a little bit less than 3%. And a large part of that is due to the US central bank, the Federal Reserve, lowering its policy rate to zero. So monetary policy, which is the central bank's policy rate, is very supportive, but so is fiscal policy, which is how much the government is spending. That tends to stimulate the economy, and that's exactly what governments have been trying to do to overcome the drag on growth due to the pandemic. But we've seen a very clear divide between emerging markets and developed markets, because emerging markets generally can't afford to have too much fiscal generosity. So if you look at the right-hand side of this graph, you can see that for LIDCs, which are low-income developing countries, those are the countries which have had the smallest spend in order to overcome the drag from the pandemic. And as we go from poorest countries to the most rich countries, you can see that gradually the fiscal largesse has increased as countries get more wealthy. So in the countries where there has been a lot of fiscal stimulus, that's going to be positive for the economy, positive for wages and employment, and ultimately that's positive for the housing market. Now here's a survey that was done in the UK, but I think it has global application, which talks about reasons for moving house. And it says if you've moved or are considering moving, what are your reasons for doing so? Now, of course, people move to a different area, that's always the case, but recently a lot more people have been saying they want to access outdoor areas and a garden. Because if you've been locked up at home during the pandemic, you've probably been pining for a little bit of outdoor space. Also, you probably want to have more space in your house. And that might have been a driver behind moving away from urban areas to more rural areas, or at least the suburbs. Because generally house prices tend to be lower there, plus you get more access to green space. And as economic activity recovers to something resembling normality, it'll be interesting to see if this trend away from city centres continues. And another welcome development is that many people across the world have had a dose of the COVID vaccine. And that's had a dramatic effect in countries where vaccine uptake has been very high in cutting new cases, and very importantly in cutting deaths. But again, notice the big split between rich countries, which are generally above me here, and poor countries which are below me. And presumably poorer countries haven't been able to afford to vaccinate so many of their people so rapidly. But certainly in developed markets, this has been a big positive for the housing market, because it means we can get back to a normal life and economic activity increases, as do wages and employment. But of course there are always negative factors. This is a graph of the US unemployment rate since 2015, and you can see before the pandemic hit, it reached a 60-year low of just 3.5% unemployment. Then as those service sector jobs shut down due to the pandemic, we saw unemployment rise very rapidly, but then almost equally rapidly we've seen that unemployment rate fall again. But what's worrying is that that recovery seems to have slowed down. So in the US at the moment, unemployment is still 5.8%, and it seems to be taking a long time to recover to pre-pandemic levels. However, the unemployment rate is highest for people with the lowest wages. That's because people in the service sector jobs, which tend to pay very little, have been hardest hit by the pandemic. And home ownership amongst that group of people tends to be lower. And I think that's one reason why house prices haven't had a huge negative impact from this spike in unemployment. But certainly this scarring effect is a negative for house prices. Now, if house prices are affordable, that means there's more upside for house price growth. And conversely, where house prices are very expensive, you get less upside. So in this red ellipse, I've highlighted the countries where house prices are highest and there's the least affordability. The x-axis of this graph is the price to rent ratio, which is one way to look at house price expensiveness. And the y-axis here is the price to income ratio, where we take the average price of a house and divide it by the average income for a given country. Now notice how the countries tend to fall on a straight line here, because both measures tend to agree on which countries are expensive, with New Zealand being the most expensive, alongside Canada, Norway, Sweden, Australia, the UK, Belgium and Denmark. Whereas these countries in the bottom left tend to be ones where house prices are cheaper. And notice that also includes the US and Japan. So all else being equal, we'd expect these countries in the top right to have smaller upside for their house prices than the countries in the bottom left. Now let's look at the UK market in detail. This is data taken from the nationwide house price index, which is one of the largest ones for the UK. And notice how since the pandemic there's been an acceleration in house price growth, such that recently it hasn't been much below 12% on a year-on-year basis. But one consequence of that is the UK's price to earnings ratio, which is the average price of a house divided by the average earnings of a household, that's been pushed to near all-time highs. And as we've already said, that lack of affordability will be a drag on UK house prices. If we look at the supply of new houses in the UK, since 2013 that's been gradually increasing, and currently it's at the highest levels it's been at for decades. Now in the UK there's always a big demand for houses, but the supply has been limited. So it's reassuring to see that that's being corrected, but at the margin an increased supply of houses means that unless demand increases as well, that tends to push down prices. Now, the new lifeblood of any housing market are first-time buyers. This is usually young people buying a house for the first time, and for these buyers, they're very price sensitive. And if we look at affordability for first-time buyers and break it down by London or the North, you can see there's a massive divergence. It's as if the UK is split into two countries, such that London, which is above me, is extremely unaffordable, whereas the North shows a fairly stable and low house price to earnings ratio. So it's certainly not the case that the UK is not affordable everywhere. There's a very clear divide amongst different regions. And if you go to the Office for National Statistics in the UK, there's a brilliant interactive tool which lets you look at different regions in terms of the price to earnings ratio. You can see there's a fairly clear split here between the southeast and Cornwall, which tend to be very expensive, and Wales and the north of England, which on the whole tend to be cheaper. And if you look at this graph, which is just above me, you can see if we compare Kensington and Chelsea, which is the most expensive region in the UK, with the average price to earnings ratio in the rest of the UK, it's far more expensive. Although it's interesting that that has come down recently. Now, one way to solve that affordability problem is for us to earn more. So wage growth is a critical thing to monitor when thinking about house prices. This shows the real wage growth, that's above the rate of inflation, going back to before 2003 in the UK. Notice how after the global financial crisis in 2008, wages in the UK didn't keep up with inflation for several years. So it's reassuring to see that recently there has been a pickup. However, some of that is due to compositional effects. And that's because those service sector jobs which we mentioned, which aren't very well paid, have dropped out of the average. And by taking out a lot of the lowest paid jobs, that's pushed up the average earnings. So we'll have to wait until the furlough schemes end to gauge whether this really is real wage growth. But that certainly is a positive, and it's a critical thing to monitor. Now let's consider the US. If we look at the price to income ratio, which measures affordability for the US, when this number is high, that means house prices are unaffordable. And when it's low, it means they're very affordable relative to earnings. Now, recently, house prices have been increasing very rapidly in the US, but they're still well below levels that we saw just before the global financial crisis in 2006. So it's certainly not the case that the US is looking expensive. There's a lot more room for price to earnings ratios to increase further. And if we do see wage growth in the US being strong as well, then that's even more of a bullish story for US house prices. If we look at US housing starts, and a US housing start occurs when excavation begins on a house, not when it's completed. After the financial crisis, there was a big lull in house building in the US, but since then it's been rapidly building up, and the creation of new housing supply seems to be accelerating recently. Now, an increase in supply tends to be negative for house prices, so that's certainly a variable that we need to watch in order to gauge what happens to prices in future. Now, one of the things that was holding back creation of new houses in the US was supply bottlenecks, and the one everyone was talking about was lumber. And because the supply of lumber was insufficient to meet new demand, we saw lumber prices skyrocket in the US. However, that seems to have peaked in May, and it's been falling very sharply ever since. So what we'd expect to happen now that that bottleneck has eased is that supply would increase further. Availability of credit is also important for the housing market because that means people can borrow more easily, and that tends to push up prices. And one way to monitor that is via the Senior Loan Officers Survey, which is published by the Federal Reserve. Now, if we see tightening in residential mortgage loans, that means mortgages are harder to get. And that's exactly what we saw at the peak of the crisis. But since then, we've seen that number turn negative, which means that conditions are easier. So that's a positive for US house prices. And if we look at the delinquency rate for US single-family residential mortgages, which is the percentage of mortgages that fall into arrears due to financial hardship, there were worries that delinquencies would spike once mortgage forgiveness programs ended after the pandemic started to subside. However, so far that doesn't seem to be the case. Delinquency rates have ticked up slightly, but you can see that's insignificant when we compare it to delinquency rates in 2010. But that's certainly one to watch once all of these mortgage forgiveness programs end. And if we look at the largest US cities, you can see there's a big dispersion in house price growth, with the large cities at the top here, such as Phoenix, Boston, Portland, and LA, having the greatest house price growth since just before the pandemic, whereas Chicago, Las Vegas, Atlanta, and Minneapolis have the weakest growth. But even for those cities, I think you'd admit that that house price growth is pretty strong. Now let's end with a forecast for house prices. And this model was created and published in The Economist, and it uses a statistical method called a random forest to predict what's going to happen to house prices in the future. So for example, the model finds that house building, the rate of new supply, isn't particularly important for house prices in the 1 year and 2 years ahead. Whereas the rate of unemployment is incredibly important, such that when unemployment is high, that tends to be a drag on house prices, both on a 1 year and 2 year basis. Rising household income has a positive effect, as you'd expect, because if people have a larger disposable income, they can afford to buy more expensive houses. If house prices are affordable, again, that's a positive over a 2 year basis. And because interest rates affect funding costs, when rates are high, that's a drag on house prices. So these are some of the factors that go into that random forest model. Here are the 8 countries for which there's a forecast from the model. This was published in April 2021, and the forecast runs to Q1 2023. Now, the forecast over that period is the arrow and number that you can see for each of these graphs. And the countries with the highest forecast are France, which is here beside me, which is forecast to grow at an annualized rate of 4.2%. And the second highest annualized growth is for Germany, which is forecast to grow at 4%. The US is 3.5%, and Britain and Australia are 3.2%. And the lowest forecast growth is for Spain, which is only supposed to grow very slightly at 0.7%. I take that model forecast with a pinch of salt. They're never very reliable. What I'm much more interested in is what you think is going to happen to house prices. Share that with us in the comments below this video. And if you do want to support us, you can do that directly on YouTube by clicking on the join button or by clicking on the link beside me. And as always, thank you for listening.